What's up, investors? It's the Russian dude. Let me give you approximately 1 minute update from the crypto market because there are some very interesting things happening right now. First of all, last day the total inflow into Bitcoin ETFs reached more than $100 million, which is a very big number. But at the same time, the total activity by Bitcoin whales, according to this graph, as you can see, reduced recently. And these are the people or organizations which are capable of moving Bitcoin price up or down. At the same time, the overall sentiment on the crypto market and specifically Bitcoin market right now switching towards more negative. And once again, more potential reasons why it is happening. It is because the crypto market matured. People did expect a lot of explosive growth in the Bitcoin price after halving happened, which it did not. So people were like, well, okay, so now we cannot make triple X gains in one single day. Speaking about halving, as you can see, the hash rate for Bitcoin also started reducing, and historically hash rate was correlating with the price. Hash rate goes up, the price goes up, hash rate goes down, the price goes down. The reason for this is also once again halving. As soon as the reward for Bitcoin mining literally reduced in half, a lot of Bitcoin miners, they simply exited this business. At the same time, according to the technical analysis, as long as you believe in it, the current resistance level for Bitcoin is approximately $66,200. And as you can see, at least at the moment of recording this video, Bitcoin price was literally flirting with this number. Resistance, what it basically means, if Bitcoin price can breach it and then it tests it and then rebounds back, this is a good news. But if Bitcoin price reaches resistant levels and then goes down, tests it again, and then goes down, this is not so good news. So let's keep a close eye to Bitcoin price, specifically this target around 66,000 in the next couple of days. And just overall right here is the fear and greed index, which shows that the stock market sentiment is switching towards positive, which is right now 59 out of 100. And the crypto market is now a little bit down for the previous day. Now it is 64 out of 100, down from 66. But okay, now even quicker update on this GameStop saga day 3. I'm gonna try and be done in also less than a minute. First of all, the third day of trading, the meme stocks opened with losing its value. Specifically, GameStop at some point lost approximately 26% and then the stock recovered a little bit. AMC lost approximately 18% and also recovered a little bit. The trading was also halted temporarily because the price decline was very sharp and very fast. And as you can see, the trading volume in GameStop recently literally skyrocketed. Trading volume involves both buying and selling. But as you can see, the current price of GameStop shares, which is applied to the GameStop shares performance during May of 2021, as you can see, we still have a long way to go. Personally, I do not think that we will repeat 2021 because things like this, they do not simply happen for the second time in a row whenever people are expecting, oh, it's gonna happen again, 700% growth, I'm gonna buy it, and then I'm gonna get rich. A lot of people expect it's gonna happen, which basically means most likely it's not. But we do have some small hope. This guy, once again, Jim Cramer, who always makes predictions about the stock market and they turn out to be completely the opposite. He's saying that, guys, be careful about this meme stocks money in GameStop and AMC. You better sell your shares right now and lock in your profits. Well, historically, everything's supposed to happen exactly the opposite. Let's see. But okay, let's talk about some serious stuff. And we begin with a predominantly surprisingly good most recent CPI inflation report. So the numbers came in as the following. The month-over-month increase is 0.3%, which is down from the previous month-over-month increase of 0.4%. And year-over-year increase is 3.4%. In comparison to the previous year, 3.5%. But core CPI inflation is up 3.6% year-over-year, with the previous one being an increase of 3.8%. As you can see, we did have a slowdown, very small, very minor slowdown, but a slowdown. Finally, for the good expectations of the Federal Reserve and Jerome Powell. But still, guys, don't forget that the target is 2%, which still means that the current inflation is almost twice higher than the Federal Reserve target. And the reason why it was a relatively good report because core CPI inflation finally cooled down for the very first time in at least last 6 months. Because of this, it now finally allows the Federal Reserve to have a little bit softer narrative in the future, because this was one of their main criteria to decrease the inflation, so which will allow them to start reducing the interest rates. As a result of this report, the S&P 500 index reached its all-time high numbers. But at the same time, we cannot forget that the CPI inflation expectations were a little bit elevated. That is why whenever the CPI actual inflation is lower than these elevated expectations, once again bringing us to the original argument that we're still far from the targeted inflation of 2%. And this last 1%, no matter how small it sounds, it will be extremely hard to shave off. And ultimately, as a result of all this, we do have some expected and unexpected consequences. So let's finalize this video talking about this right now briefly. First of all, the returns of corporate bonds significantly outperformed the performance of the government bonds. The reason for this is obviously once again because right now we have high interest rates, and this is what the government is just trying to follow. So yeah, they do have there some kind of return for this. The banks, they continue to receive the interest payments based on this one. But why corporate, specifically bonds, significantly outperform the government bonds? Companies, unlike government, they do still need to fight significantly for their potential customers and investors. That is why they do release bonds with a little bit more attractive percentages, interest rates, once again just to attract as much capital as possible. Because of this, obviously there is so much interest from people, especially from bond investors, bond holders, to buy right now corporate bonds rather than government bonds, which are just a little bit higher than the interest rates set up by the Federal Reserve. Simply saying, there is much bigger competition in corporate bonds, industry of the economy, sector of the economy, rather than in just government bonds and treasuries. And another not that obvious consequence of this situation is that the home prices expectations, they went up significantly, the highest number since 2007. This is not a very good news if you're a first-time home buyer or just a home buyer, because right now we're in the worst case scenario on the real estate market. Traditionally, the interest rates are high, meaning that the home prices are low, but when interest rates are low, the home prices go up. What we have right now, interest rates are high, home prices are high, and the expectations for the home prices, they are even higher. But if you are a home owner, or if you are planning to sell your home in the near future, or if you're a real estate agent, right now is your just paradise market. So I mean, take advantage of this, enjoy making fun of us, people who still cannot afford a house. Right now is your time to shine. Well, there you have it, guys. As always, thank you so much for attention. Please subscribe to my channel and like this video if you found this information useful, and see you tomorrow.